Hi, my name is Stanley, and here are the top 5 mistakes that stop investors from beating the market. The first mistake is not understanding the difference between investing and gambling. An investment operation, according to Ben Graham, is one which, upon thorough analysis, promises the safety of the principal and adequate return. Operations not meeting these requirements are speculative. So, story time. I once went out with my girlfriend to a casino to play blackjack. We played our first round and won. Second round we won. Woohoo. Third round we won. Wow. And fourth round, I immediately dragged my girlfriend kicking and screaming away from the table. And the reason is because I knew our luck was going to run out soon. Was it because we were that skilled that we successfully tripled our money, or were we just lucky? Let's do some research here. So in a game of blackjack, assuming absolutely perfect play, and neither myself nor my girlfriend are professional gamblers, here are the odds. Your chances of winning, 42.22%. Your chances of losing, 49.10%. Your chance of it being a push or a no-one-win scenario, 8.48%. So the odds of us winning 3 games in a row against the house are 0.4222 to the power of 3, 7.5%. And this is assuming that we played perfectly, which is a bit of a stretch. So we were really, really lucky. And here's why I thought our luck was going to run out soon. The chances of us winning 4 rounds of blackjack right after the other is 0.4222 to the power of 4. That's 3.2%. Wow. So if you plot the risk versus reward chart for blackjack, it probably looks something like this, meaning the higher the risk you take, the more you can win, but the more you can lose. For example, I could YOLO my life savings in blackjack, and I could double my net worth immediately, or I could lose all my money. If you invest with a risk and reward chart that looks like this, then you're not really investing, you're gambling. Now, let's look at the returns of the absolute OG in investing, Warren Buffett himself. Over the past 60 years, he's had mostly up years, some down years, averaging a 20% return each year over 60 years. Wow, talk about consistency. If we were to plot Warren Buffett's risk versus reward chart, it looks something like this. And this is because the consistency of his strategy allows him to increase his reward without increasing the risk he's taking. This is the risk and reward chart you should be striving for while investing. Now, the key to increasing your reward without increasing your risk is staying within your circle of competence. Your circle of competence is essentially what you understand to be true. Going outside of your circle of competence means you're going outside of your realm of understanding, where it becomes hard to know whether or not the company you're buying is attractively valued or way too expensive. It's really important to be honest with yourself and not try to overanalyze anything that's too difficult to understand. When you try to touch areas you don't understand very well, you're inevitably increasing your risk. For example, one company that I'm really comfortable with owning is Google. I use their products all the time: YouTube, Search, G Suite, Android, Cloud, and I'm pretty confident that all of these businesses are going to do really well in the long run. Another company that I'm really comfortable with owning is McDonald's. It's one of the most recognizable brands in the world. They own a ton of real estate, and they've been consistently making money each year on rent and fees paid by franchisees and food sales. And also, who do you know has never eaten a Big Mac before? When these companies sell for attractive valuations, I want to buy them. One area that's outside of my circle of competence is biotech. These companies have the potential to generate really amazing returns if they make a research breakthrough, but it comes with really bad consequences for investors if the company hits a regulatory hurdle or the products fail to make it to market. And even though there are many people with much more extensive medical backgrounds than me have made fortunes from biotechnology, this is an area that I don't really know what I'm doing, so if I invest, my risk is going to go way up. To consistently beat the market in the long run, you have to focus on companies that are within your circle of competence so that you can control risk. The second mistake that prevents you from beating the market is something called FOMO. If you've been in the investing space, you've probably heard of FOMO. It stands for fear of missing out. This is when you see a bunch of people make money hand over fist in a certain hot sector that's experiencing a boom, and you feel left out. So you join in the hype in an attempt to not be left out and to also make a lot of money. Now, let me interest you in the 5 stages of an asset bubble. At the beginning, we have displacement. This is a trigger event that creates interest in a particular asset. Next, we have the boom. This is where early investors come in and asset prices rise rapidly. Next, we have euphoria. You can usually tell when you're in this phase when a bunch of people are making decisions expecting the asset to go up and up and up without actually caring about the price that they're actually paying. Then prices hit the peak, smart investors start selling, prices go down, people start panicking, the price crashes, lots of people lose money. Here are some examples of bubbles you might be familiar with. One, the internet bubble, which led to the dot-com crash in 2000. The housing bubble that led to the 2008 financial crisis. The cryptocurrency bubble that led to the 2018 crash and the 2022 to 2023 crash. The 2021 tech stocks bubble, which crashed in 2022. And the AI stocks bubble, which we might be entering into right now. And in almost all these cases, the question of exactly where we are in this bubble cycle was unknown to even the brightest and smartest business and investing minds. So the key to avoid losing money because of FOMO is asking yourself if you're buying an asset because you're very confident it will become more valuable in the future, or if you're buying an asset because everyone else thinks the price is going to keep going up forever, and you don't want to be left out. And there's nothing wrong with investing in assets that are in a bubble if you understand what you're buying, why you bought it, and the risks versus upside. In other words, staying within your circle of competence. For example, if you bought Amazon at the peak of the dot-com crisis because you were confident in the long-term potential of the business, you would have lost money in the short term, but long-term, you would have made it big. The same if you bought Bitcoin in 2013 for $12.38 right before it crashed to $100. If you held on to Bitcoin, you'd be doing pretty darn well right now. Now, understanding what you're buying in each of these situations, one, stops you from panic selling, and two, helps you to accumulate more of the asset while others are fearful. However, if you didn't really understand why you bought the asset and you panicked when the stock price crashed and sold everything, you can lose 50% to over 90% of your original investment, which can take years, if not decades, to recover. Third mistake, paying too much for an asset. To explain this concept, I'm going to ask you a personal question. What is your dream car? The one that you would get if you had all the money in the world. I'm expecting all kinds of answers here. Maybe it's a Bugatti, Lamborghini, Ferrari, Porsche. Now, let me ask you another personal question. Do you think someone should pay $1 billion for your car? I would hazard a guess that for most of you guys, $3 to $5 million, you could probably buy your dream car. Even if you wanted the fanciest Rolls Royce you could find, I think $50 million should cover it. $1 billion is just an absurd amount to pay for a car. The point of this example is to show you that price matters, even for the most desirable items that you would absolutely kill to have. The great investor, Howard Marks, who averaged a 20% return over multiple decades, explains it really well in his book, The Most Important Thing: Uncommon Sense for the Thoughtful Investor. Here he explains first versus second level thinking. First level thinking could be, this is a great company, let's buy the stock. The second level thinking could be, it's a great company, but everyone thinks it's an amazing company and it's not. So the stock's overrated and overpriced, let's sell. So if you really like a company and you think in the long run it's going to do well, you need to find out how much of the growth of that company's revenue and earnings is already priced into the stock. If you believe with a high degree of confidence that the market is not recognizing the massive potential of the growth of the company, then go buy it. However, if you analyze that company and you find out that much of the future growth potential is already priced into the stock relative to the risk, you might want to reconsider. This is because the more expensive the company is, the more investors expect out of the company, and the harder it is for the company to exceed expectations. And when the company no longer exceeds expectations, or something unforeseen happens, God forbid, or the market turns, expect the market price to drop significantly for that stock. So a recent example of this is during the tech boom of 2021. Companies like Roku, Shopify, Carvana, and others rocketed up during this time where they were seeing high levels of growth and investors were piling on higher and higher in expectations. Eventually in 2022, when the market turned and they could no longer exceed expectations, their valuations crashed by more than 90%. Now, to beat the market consistently, you must buy companies where the growth potential has not been fully priced in by other investors. And if you're not sure whether or not the growth has been fully priced in or not, or if you're not sure what stage of the bubble cycle you're in, just accept that this investment opportunity is outside of your circle of competence and move on. So the fourth mistake is getting involved in value traps. Let's use a car example again. So it's the same exact scenario, but just in reverse. Let's say that you go into a used car dealership and the salesman is offering to sell you a used car, say made in 2015 with under 50,000 kilometers, and he's offering to sell you it for 6,000. And you take the car to your mechanic only to find out that it has serious engine problems that can cause it to break down on the highway. Would you still buy the car? Of course not. This example is to illustrate that even if you find a dirt cheap product, if it's a piece of junk, it's not worth buying. Now, if you've been investing long enough, you might be familiar with some of these ratios, which are used to identify whether or not companies are cheaply priced relative to how much they're trading for. Some examples are price to earnings, price to sales, price to book value, price to cash flow, and debt to equity. And hold your horses if you're going to be making investment decisions just based on these metrics. Almost all the companies are cheaply priced for a good reason. It could be that the company is in a declining industry, the company is run by incompetent management who love destroying shareholder value, the company has a serious risk of not meeting its debt obligations, the company is losing market share rapidly to competitors, or the company is in a cyclical industry and it can't sustain its profits. If a company is trading for cheap, find out why. If you're very confident that the market is underestimating the future prospects of your business and that something's going to happen in the future that's going to cause everybody to rethink their opinion of this company, it could be a really good investment opportunity. However, if you find out that the company is trading cheap for a very good reason and you're not really seeing anything in the future that's going to change investor expectations, then you got to steer clear of this because it could be a value trap. Now, you get involved in a value trap when you invest in a company because it's cheap without doing proper due diligence on the quality of the business you're buying. In these cases, investor expectations can remain the same or go lower from the time you purchase the business, causing you to essentially have a stagnant investment for multiple years. And there's a term called bag holders, which are used for investors who hold on to value traps even when the companies they're invested in decline year after year until it goes to zero. And if you want to beat the market, you do not want to be a bag holder. So the fifth common mistake that investors make which stop them from beating the market is getting the diversification equation wrong. Some overly cautious investors over-diversify and they invest in so many stocks that they can't even keep track of them. Doing this dilutes their overall performance because instead of investing in only their best ideas, they invest in okay, good, and bad opportunities which cancel each other out. And if you over-diversify, you're going to find it very hard to beat the market. On the other hand, there are cases of retail investors who put most of their life savings into one stock, and this is called over-concentration. While there can be a really large upside to concentrating your bet on one investment, there can also be a huge downside if that business does poorly, which causes you to lose a lot of your money. To help understand the question of diversification better, let me give you two quotes by two legendary investors. Here's what one of the greats, Ray Dalio, has to say about investing. If you can get 10 or 15 good uncorrelated investments, you can reduce your risk by up to 80% without reducing your return. And here's what Warren Buffett has to say. Diversification may preserve wealth, but concentration builds wealth. I can pretty much summarize this as 1. You should only invest in your best investment ideas. 2. When you have multiple investment ideas of equal quality, you should invest equally in all of them rather than just one idea. While the question of how much diversification you need depends on each investor, from my personal experience, I believe the magic number lies somewhere in between 5 and 15 investments accumulated over multiple years. This gives you the ability to concentrate your bets on your best investment ideas at certain given times, while reducing the risk of loss if, say, you made a few mistakes in some of your analyses. I hope you found this video helpful in outlining the top 5 mistakes that stop you from beating the market. If this video helps you to make better investment decisions, please consider giving it a thumbs up and subscribing for more content. Let me know in the comments what kind of video you'd like to see next. Thanks, guys.